If you've been putting money into your 401k, index funds, or the stock market for years, and you're wondering, is this really the best way to grow my wealth? You're not alone. Today, we're going to break down a powerful alternative to Wall Street's passive investing in real estate. We're going to look at both options side by side. We'll cover risks and volatility, cash flow, tax benefits, control, and historical performance. I think it's important that investors understand that the prudent approach to investing is always going to be diversification. The challenge is most people's portfolios are only diversified inside of Wall Street and not in Main Street type investing. So I always encourage all investors to consider that dual approach of how can I best maximize my investment returns in Wall Street related investments, and how can I ultimately look to diversify into cash flowing hard assets that are largely tax advantaged through depreciation and also offer a hedge against inflation. Multifamily is not immune to the fluctuations in different market cycles. So it's important for investors to understand that just like your financial advisor would encourage you to dollar cost average into Wall Street related investments and products, the same prudent approach can be applied also when it comes to investing in multifamily properties as well. There's just simply going to be times during the course of the market cycle where it makes sense to buy, and there's going to be times where it maybe makes more sense to sell. So when you're an investor in Wall Street, you're subject to something called a capital gains tax on your profits. The same rule applies when you invest passively as a limited partner in multifamily. The difference, however, is those investments have something called a passive paper loss that you're able to utilize. It's otherwise called depreciation, that you can leverage to offset the capital gains taxes that you receive on your distributions, and also a large portion of the profit that you receive on that investment when that investment deal goes full cycle. So does real estate offer any hedge against inflation? That's the beautiful thing about investing in a hard asset that's cash flowing, is that as inflation pressures continue to deteriorate the dollar, those costs eventually end up in the saleable price of a multifamily property today. We call that in the space organic rent growth. So we typically see over the course of a 50-year period, average annual organic rent growth is going to average about 2 to 4% depending upon the market itself. That organic rent growth is largely the byproduct of inflation pressures. It's just the value of these properties continue to increase the more inflation pressures there are in the market. When it comes to risks, I like to identify three primary ones. Number one, you have operations risk. Number two, you have execution risk. And number three, you have market risk. So when it comes down to those three risk factors, you must align with an operator who mitigates against the operations side of the business, that mitigates against the potential for execution risk over the course of that investment hold period, and then an operator that's conservatively stress testing the financials, doing sensitivity analyses so that they're really largely protecting their investors against the unlikely scenario where there is a potential market downturn in the future. The challenge sometimes with Wall Street is oftentimes people are making daily emotional decisions. And it's just very difficult, I think, for most investors to understand exactly how Wall Street works on the back end, behind the closed door. And the one nice thing about investing in multifamily real estate is it's a tangible asset that you can visit the property, you can talk to the local on-site management staff, you can talk to, the main leadership staff that's managing, the asset over the course of the investment hold period. So there's definitely room to invest in both multifamily real estate as well as the stock market. Again, the prudent approach for all investors is diversification. If you're overly invested in Wall Street and you don't currently have investments in Main Street type vehicles, then it's certainly something that you ought to take a look back and maybe consider deploying a certain percentage of your net worth into a hard asset that produces regular, consistent cash flow that's also tax advantaged through the power of real estate investing. So why do I believe passive investing in real estate is really truly one of the best strategies to build wealth creation? It really comes down to four main factors. Number one being diversified outside of Wall Street and into Main Street, but not sacrificing additional time where you actually have to actively manage the real estate. There's great operators out there like Rise48 that will certainly do that for you. Another big one is regular, consistent cash flow that's produced off of these investments. The nice thing about regular, consistent cash flow is you're really locking in profits on a month-by-month basis on your investment. Another huge one for me is the tax advantage. I didn't get into real estate because of the tax advantages, but it's one of the main reasons I'm staying involved in investing in real estate because of the power of that depreciation tax benefits. And really the last one comes down to that hedge against inflation and being able to really hedge against that, big inflation monster out there that continues to erode our purchasing power each day. All right, so thank you so much for joining us today. It's been a pleasure to talk through passive investing in real estate and how that kind of can complement or contrast your Wall Street related investments. If you'd like to learn more about passive investing in real estate with Rise48, please do reach out to us at rise48equity.com.